Your bank account is not private. You probably knew that in a general sense. Most people do. But what most people do not know, and what the IRS has never sent anyone a letter explaining, is the specific list of behaviors that their automated systems are programmed to flag right now in 2026. Not behaviors that are necessarily illegal. Not behaviors that are necessarily suspicious. Behaviors that millions of ordinary Americans engage in every single month. Depositing cash, moving money between accounts, receiving payments from family members, making large withdrawals, that are triggering automated reports to the federal government without a single phone call to the account holder. The IRS entered 2026 with a fundamentally different set of tools than it had 5 years ago. Advanced artificial intelligence systems are now cross-referencing your tax return with bank records, third-party data, and behavioral patterns to detect inconsistencies. The system that used to rely primarily on human reviewers looking at paper returns now runs AI-driven models that never sleep, never take a day off, and are specifically calibrated to identify patterns that deviate from what the system considers normal for a person in your income bracket, your age group, and your geographic area. And here is the part that makes this specifically serious for seniors. The financial behaviors that the IRS automated systems are programmed to flag most aggressively in 2026 overlap significantly with the completely normal, completely legal financial behaviors of retired Americans. Moving savings from one account to another after a spouse passes away. Depositing cash accumulated at home over years of careful saving. Receiving money from adult children. Making large withdrawals to pay contractors. Liquidating a long-held asset. All of these are routine financial events in retirement, and all of them, under the right circumstances, are generating federal reports that most seniors have no idea exist. The automated systems that identify these patterns, the DIF scoring, the automated underreporter program, and the third-party data matching, run whether there is a human examiner ready to follow up or not. The flag gets placed. The file gets opened, and you find out about it when a letter arrives. The first behavior that is generating more IRS flags in 2026 than almost anything else involves something most seniors think they already understand. Cash transactions near $10,000. Everyone has heard the $10,000 rule. Deposit more than $10,000 in cash and your bank files a currency transaction report with the federal government. Most people think the solution is simple. Keep deposits under $10,000 and the report does not get filed. That reasoning is not just wrong. It describes a federal crime. The crime is called structuring, and it is defined under federal law as deliberately breaking up cash transactions into smaller amounts specifically to avoid the $10,000 reporting threshold. The intent to stay under the limit is the crime, not the amount, not where the money came from. Multiple deposits just under $10,000, what the IRS calls cash-intensive activity, suggest intentional structuring to avoid federal reporting requirements, and the IRS flags this pattern automatically. What makes this particularly dangerous for seniors is that many of them keep cash at home. Money saved over years, insurance proceeds, money from selling personal property, and deposited in amounts they consider manageable. Not to avoid anything, simply because that is how they have always handled money. But the automated system does not know their intent. It sees the pattern. It generates the flag. And the account holder gets a letter or, in more serious cases, a visit. The protection is straightforward. If you have accumulated cash from a legitimate source and need to deposit it all at once and document the source. One large deposit from a documented legitimate source generates a routine CTR that produces no consequence. A pattern of deposits just below $10,000 generates a structuring investigation regardless of how innocent the intent. The second behavior that is pulling senior accounts into IRS visibility in 2026 involves something that changed significantly, and that many seniors have still not heard about. Payments received through apps like Venmo, Zelle, PayPal, and Cash App. For years, seniors who received money from family members through these platforms assumed the transfers were essentially invisible to the IRS. Informal, personal, not subject to any reporting requirements. That assumption was largely correct under the old rules. The rules changed, and then they changed again. The controversial $600 threshold that was supposed to hit payment apps and bank accounts has been officially rolled back by the One Big Beautiful Bill Act. The threshold for Form 1099-K has reverted to the old standard, $20,000 in payments, and 200 transactions for 2026. That is the good news for seniors receiving occasional family payments. Those informal transfers are not generating 1,099K forms at the current threshold. But the IRS is not relying solely on the 1,099K to monitor these platforms. The broader issue is that payment app transactions, particularly transfers that look like income rather than personal gifts, are subject to scrutiny when they show up as deposits in a bank account that does not report corresponding income on a tax return. If the IRS's automated systems identify regular incoming transfers that do not match reported income, the flag is automatic. The practical guidance is documentation. If you receive regular payments from adult children for rent, household expenses, or care, keep written records establishing the nature of those transfers. If you receive a large one-time payment that represents a family loan repayment, gift, or sale of personal property, document it. The IRS is not looking to tax every dollar that moves through your PayPal account. But when incoming transfers pattern match to unreported income without documentation to explain them, the automated system flags the return. The third behavior involves something seniors do more frequently than any other age group, and that has been added to the IRS's automated flagging criteria in 2026. Mismatches between reported income and bank deposits. One of the leading causes of IRS audits is discrepancies between reported income and information submitted by employers, banks, or third parties. Even minor inconsistencies can trigger automated notices or audits. For seniors, the most common version of this mismatch involves retirement account distributions. When you take a withdrawal from a traditional IRA, a 401k, or a pension, the financial institution files a 1099-R with the IRS reporting the distribution amount. The IRS's automated system then looks at your tax return to confirm that the distribution was reported correctly, that appropriate withholding was applied or taxes were paid, and that the amount matches. Seniors who take IRA distributions and forget to include them on their return, or who withdraw from retirement accounts without realizing the transaction generates a 1099-R, are among the most consistently flagged groups in the IRS's automated underreporter program. The financial institution has already told the IRS how much came out of the account. If your return does not reflect that number, the discrepancy triggers an automated CP 2000 notice, a letter telling you that the IRS believes you underreported income and proposing additional tax, penalties, and interest. The same mismatch issue arises with unreported interest income. Many seniors have savings accounts, money market accounts, or CDs that generate interest income throughout the year. If the amount is below $10 for a given account, the financial institution is not required to issue a 1099 INT, but the income is still taxable. And when seniors aggregate interest across multiple small accounts and fail to report some of it, not from intent, but from oversight, the IRS matching system catches it. The fourth behavior that is generating senior account flags in 2026 is one that most seniors would never guess is on the IRS's radar at all. Large charitable donations that don't add up. Charitable giving is one of the most common deductions claimed by Americans over 65. It is completely legitimate. It is encouraged by the tax code. But it is also one of the most aggressively monitored deduction categories because it is one of the most frequently inflated. A taxpayer earning $75,000 and claiming $30,000 in charitable donations is more likely to be flagged than someone earning $300,000 claiming the same amount. The IRS's DIF scoring system compares your charitable deductions against a statistical profile of what people in your income bracket typically donate. When the ratio is significantly above the norm, the return is flagged. For seniors who are genuinely generous, who give substantially to their church, their community, or causes they have supported for decades, the protection is documentation. Every charitable contribution of $250 or more requires a contemporaneous written acknowledgement from the receiving organization. Clothing and household items donated to organizations like Goodwill must be assigned fair market value, not original purchase price, and that valuation must be supportable if challenged. Non-cash donations above $500 require Form 8283. Non-cash donations above $5,000 generally require a qualified appraisal. Seniors who have been giving generously for years based on their own valuation of donated items, without the documentation structure the IRS requires, are in a more vulnerable position than they may realize. The deduction itself is not the problem. The absence of documentation to support the deduction is what turns a legitimate charitable gift into an audit trigger. The fifth behavior involves a change in IRS technology that most Americans do not know has been fully implemented. and that fundamentally changed what financial transactions the IRS can see. Digital asset transactions. Starting with the 2025 tax year, the IRS introduced Form 1099-DA. Brokers, including cryptocurrency exchanges, payment processors, and certain wallet providers, are now required to report transactions. If you check No on the digital asset question on your tax return and the IRS has received a 1099-DA reporting otherwise, that inconsistency is a near-automatic trigger for a correspondence audit. Many seniors have digital asset exposure they do not fully recognize. Investment platforms that have added cryptocurrency features in recent years. Brokerage accounts that began offering Bitcoin ETFs or similar products. Retirement accounts that have diversified into digital assets through fund vehicles. In some cases, seniors have received digital assets as gifts from family members without fully understanding the tax treatment. The rule as of 2026 is unambiguous. Every digital asset transaction, sale, exchange, or other disposition must be reported on your tax return regardless of whether you received a Form 1099-DA. The IRS has stated this directly. Taxpayers must report all taxable digital asset income even if they receive no form at all. And because brokers are now issuing 1099-DA and sending copies to the IRS simultaneously, any gap between what they reported and what appears on your return is detected automatically. The sixth behavior involves something that catches seniors in a specific and recurring situation, one that the IRS has made a priority in 2026 after years of identifying it as a significant source of underreported income. Rental income from short-term platforms. Seniors who rent out a spare bedroom on Airbnb, a vacation property on VRBO, or any other short-term rental platform are receiving 1,099K forms from those platforms, and those forms are going simultaneously to the IRS. Reporting income and expenses inconsistently, especially when it involves cash-heavy operations, raises suspicion. The platforms themselves are now required to report host income above the applicable threshold, and for seniors whose rental income arrives as a deposit in their personal checking account without corresponding income reported on their return, the automated match catches it. This situation is more common than it appears. A senior who rents a basement apartment to a family friend. A retiree with a lake house who began renting it occasionally to cover maintenance costs. A widow who started hosting a room after her spouse passed away for companionship and supplemental income. All of these scenarios generate tax obligations that many seniors have not accounted for, and all of them are now on the IRS's automated radar through third-party platform reporting. The seventh behavior is the one that pulls the entire picture together, and that represents the most significant shift in IRS enforcement capacity in years. Lifestyle patterns that don't match reported income. Under the Inflation Reduction Act, the IRS deployed an AI model called the Line Anomaly Recommender, designed to spot outliers that traditional audits might miss. This technology cross-references your tax return with bank records, public data, and even social media to detect lifestyle-to-income inconsistencies. For seniors, this system creates a specific vulnerability. Many retirees have accumulated significant assets over a lifetime, home equity, investment accounts, inherited property, and they draw on those assets during retirement in ways that may not appear as taxable income on a return. Home equity withdrawals, asset sales, gifts from family members, insurance proceeds. All of these can flow through a bank account without generating the income entries that would match the deposit pattern. When the IRS's AI system sees bank deposits that significantly exceed reported income, without clear documentation of why, it generates a flag. The system is not assuming fraud. It is identifying a pattern that warrants human review. But that review begins with a letter. And responding to an IRS inquiry about unexplained deposits requires documentation that most seniors have never thought to organize. The protection is the same across all 7 of these situations. Documentation. Contemporaneous records of where money came from, what transactions mean, and why your financial activity in a given year looks the way it does. The IRS is not entitled to your money simply because it cannot explain your deposits. But in the absence of documentation, the burden of explanation falls entirely on you. Here is the larger picture behind all 7 of these flagging behaviors. The IRS entered 2026 with roughly 74,000 employees, down from over 102,000 at the start of 2025, a reduction of about 27%. But the automated systems that identify audit triggers are not affected by staffing levels. The DIF scoring runs. The automated underreporter program runs. The third-party data matching runs. The computer flags your return whether there is a human examiner ready to follow up or not. That is the environment seniors are filing in right now. Fewer IRS employees to manually review returns, but more automated systems than ever before running against more third-party data than has ever been available. The chance that a human being randomly selects your return for examination is lower than it has ever been. The chance that an automated system flags a pattern in your financial activity and generates an inquiry is higher than it has ever been. The seniors who navigate this environment without receiving a letter are not the ones who earn less or spend less or give less. They are the ones who keep records, who document unusual transactions before they happen rather than trying to reconstruct explanations after they receive a notice, and who understand that the IRS's automated systems are not evaluating your intent. They are matching numbers, comparing patterns, and flagging deviations. Your bank account tells a story. In 2026, the IRS has better tools than at any point in history to read that story and compare it against what you reported. Making sure those two accounts of your financial life match, with documentation to explain any apparent gap, is not just good financial practice. In the current enforcement environment, it is essential. This video is for educational and informational purposes only and does not constitute financial, tax, legal, or banking advice of any kind. All information is sourced from irs.gov, Tax Problem Solver, our tax partner, Hacker Johnson CPA, RJS Law, SavingAdvice.com, and other publicly available sources current as of 2026. Individual tax situations vary. Always consult a licensed CPA, enrolled agent, or tax attorney before making decisions about your financial accounts or tax filings. Federal Decoded is not affiliated with the IRS or any government agency.